Welcome to The Keys to Your Legacy with your host, Elijah Keys. In each episode, Elijah will have a conversation with other professionals to discuss how their fields relate to trust and estate planning. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, keyslawgroup.com. Now here's the host of The Keys to Your Legacy, Elijah Keys.
Hi, thanks everybody for tuning in to The Keys to Your Legacy. I am Elijah Keys. It's a nice tongue-in-cheek name of saying that I'm an estate planning attorney. And I am very, very happy to host Natalie Oh, who is an insurance broker, president of Taran Insurance Advisory. Natalie, why don't you go ahead and introduce yourself and tell people what you do?
Great. So thank you for having me on your podcast. This is very exciting. This is my first podcast. So I'm happy to be here. So I do insurance for what I call the body. I do life, disability, and long-term care. I've been in the business for about 27 years. And for me, it's all about asset and income protection. So I don't do any sort of wealth management or anything related to that.
Okay, what do you mean by wealth management? Where is it that you draw the line here?
Well, so I will not handle a client's investments, for example. So, oftentimes a lot of folks who are insurance advisors will be also wealth managers. So they will also manage your money. So I don't do that. I don't help them grow their money. I just help them protect their assets.
Yeah. What sort of protection do people need in that sort of way?
So I think the simplest form of protection that they need is for income replacement purposes. So, especially here in Northern California, where it's a lot more expensive to live than in the rest of the country, they're typically relying on at least two incomes to support the household.
Yeah.
So if one of those incomes, unfortunately, goes away prematurely, the family still needs, something to help protect them so that they can continue living in the family home or living in the lifestyle that they were accustomed to. So that's the first one, and that's pretty straightforward. It's simple.
Sure.
Disability is, in the event that we become disabled, how do we continue paying for our bills with no income coming in because, we've been injured or because of a health issue, we're not able to work. And then long-term care is similar to that, where again, at some point, rather than depleting all of our assets that we've built up over time to pay for long-term care expenses, we, can use insurance to pay for those expenses.
Yeah, that seems like really important work. But how long have you been doing that in California?
So I've been in California since 2019, but so I came here from Chicago in 2019, and in Chicago I've been doing it for about 27 years.
Mm-hmm. Well, there's a lot of insurance agents out there, but I think that something that makes you really unique is how personable you are. You kind of know everyone.
Oh, yeah. Well, I want to know everyone, right? Because my goal is ultimately, so coming from a place like Chicago, everyone had an advisor, right? So everyone had a trust and estate attorney, everyone had a CPA, a financial advisor, et cetera. I moved here to Northern California, and there are so many people who don't have the benefit of advice like yours, right? So I think it's really important to know the right people and make the right connections, because I think that would, serve our clients well.
Yeah. Well, I mean, you're the president of an estate planning council. That means like a couple dozen, maybe even 50 professionals where you lead them and they all deal with trusts and wills and stuff like that, right?
Yeah, so I'm the vice president this year for the Peninsula Estate Planning Council. So I do work with a lot of estate planning attorneys, and all of that is in furtherance of getting the word out there about estate planning and how important it is.
Yeah. What brought you out to California?
So I've got family here. So I'm originally from Southern California. I spent 27 years in Chicago, and as I'm divorced. My daughter was getting ready to go to college, and I knew I would come back home to California. I didn't think I'd come to Northern California. So I have one brother who got married later in life, had children later, and he said, I need backup here. So that's why I'm here.
So you're auntie, is that it?
Yes, I'm auntie. Yeah.
Auntie Natalie. What do the kids call you?
They call me Como. So in Korean, that's auntie. Uh-huh.
They call you Como. That's cool. I didn't know that you were Korean, but that makes sense with Natalie Oh, right?
Yeah.
Do you still have family back in Korea?
I don't. Everyone is in Southern California, pretty much. Yeah.
All right. And what brought you into insurance? I mean, it's kind of a kind of a switch from a Korean family, I think, isn't it?
It is. Well, so what's funny and not so funny, but so I moved to Chicago to go to law school. So I was going to be a prosecutor,
Hmm.
right? And back then, they were paying $27,000 a year as a state attorney, and you leave with $100,000 worth of debt. So the math doesn't always work out.
No, it doesn't.
And I literally thought I'm going to do insurance for 1 year because I did in college. So I worked for a gentleman in Beverly Hills who did high net worth insurance for clients who had taxable estates, and so I was familiar with it. And I thought I'm going to do this for literally 1 year, and then boom, 27 years goes by just like
Yeah.
that. Here I am.
Well, explain to the people the difference. Now, when people come and see me, part of my work for them is to ask about life insurance. And so I do with almost every single client. But explain to the audience, what is the difference between a broker and an agent?
So a broker, I would say, is has access to the market, like all the insurance companies that are out there. An agent is typically employed by an insurance company.
Mhm.
There are some agents who are able to work with a couple of different carriers, but they're primarily an independent contractor for an insurance company or an employee of a particular insurance company.
So why is it important then to look for a broker versus an agent? What's the benefit of one versus the other?
In my opinion, the benefit is that you have the ability to go out to market. You don't have, so the only thing that drives me in terms of which carrier to place my clients with is entirely dependent on what the client situation is. So health is a big driver for life insurance in particular. So it really doesn't matter to me which carrier to go with as long as they're a top tier carrier. It really depends on the client's health. So who's ever going to offer them the best rating.
So when you say out to market, I want to clarify what that means because that seems like kind of an industry word. Can you maybe explain what out to market means in to what you might explain to a customer?
Sure. So, typically a client will come, and they'll say, I want insurance for this purpose. This is my health history. This is my family history. And this is what I'm looking for. And I will tell them, so while we'll apply to one specific company based on what you're providing to me as far as your health information and your history, that doesn't mean we're going to settle for whatever that carrier comes back with. So it's possible that if we don't get the rating that we're looking for, we go back out to market, meaning I approach other carriers to say, based on this information, are you willing to offer me something better for the client?
So out to market means shopping around.
Yes, yes,
But why you say out to market is that it's part of the overall insurance marketplace. Is that why it's called
yes,
out to
exactly,
market?
exactly.
Okay.
So thank you for forcing me to clarify that.
That's fine. No, no. I'm glad that you said that because I've had situations where a client comes in and they have an insurance product from a company, Mass Mutual, New York Life, and that's fine. They can have that, though they provide a very good value to the market in those specific areas. But then the client will explain why I'm paying this much for this insurance, and I'm not an insurance person, but it just doesn't sound right to me after seeing
Sure,
thousands of cases. And so I refer them out to people like you.
right, right.
Yeah. Well, so help me. So what you're talking about is you talk about that you provide money for people's body, right? Either their disability or their death. What are some reasons that people need insurance? Because you said income replacement. How much income do people want to replace, and for how
So
long?
Yeah, and those are great questions, and it really depends on the particular client. So I have some clients who will say, "Listen, I'm in my 30s or 40s. I have a young family. We just bought this home, and especially in this area in Northern California, the average price of a home is about $2 million. So they'll
Yep.
say, and my first question is, so do you have a safety net if something were to happen to either spouse? Are you able to continue living in the home?
Mhm.
And a lot of times the answer is no, right? It's driven by two incomes. And
Yep.
so that's part of what we're trying to protect. That's the income we're replacing or protecting so that the family can continue living in the home. And a lot of times if the client says, well, I only really want to worry about this till, I pay off the mortgage. So that may be 30 years
Sure.
or maybe 20 years. So it really depends on them. And then I have other clients who will say, no, this is part of my legacy planning.
Okay. So when you're thinking about income replacement, let's pretend that you gave the example. Let's keep with your example, which is a young couple in their 30s, late 30s, early 40s. They have a house and a couple of kids, and they have a mortgage. how much income is there a general rule of thumb that people should look to?
Well, so a lot of times when they'll look to replace the mortgage. So let's say it's a $2 million mortgage. So they want to replace that mortgage, and then they'll
Mhm.
say, oh, other built-in factors are college, right? So that's the
Right.
the next big one. I need to pay for college, and as we all know, it's very expensive now. So we budget in that as well.
Okay. Well, I'm thinking here. I remember speaking to a friend of mine who's a police officer, and his wife stays home, and she takes care of their multitude of kids. They have a lot of kids. And I asked, do they have insurance? And he said yes, and she said no. Would there be a reason for her as a stay-at-home spouse? And I understand that is rare in this area, but it still happens.
Right.
Would there be a reason for a stay-at-home spouse to want to buy life insurance?
Yeah. So I will have stay-at-home spouses also have it, get insurance because if they're the ones who are taking care of the children, someone else needs to do that. So you're going to be paying for that.
So when you're talking about income replacement, you're not really talking about replacing someone's income. You're talking about replacing someone's work value to the house, right?
Exactly. Yeah, that's a great way of putting it.
So if you're thinking about if you're married, if you're single, if you're whatever it is in your life, if you're thinking about your family and your situation or your friends, you want to think about your if I'm interpreting your words correctly, you tell me if I'm wrong. That someone when they're thinking about life insurance, they want to think about two different things. They want to think first about replacing their value to their family or household, number one, and number two, to use insurance as an additional tool to pass wealth. Is that right?
Right. No, that's right.
Well, I mean, that's really interesting when you're looking at someone's kind of life plan, right? What are some weird situations that you've seen that have kind of made you come off say, "Huh, that was weird. I didn't know insurance could do that."
Well, so insurance it's funny because the way everyone there's a stigma I think attached to life insurance because there is no payout until we pass,
Right.
right? But it's basically just a bucket of funds, a bucket of money that your family can use, for whatever is necessary at that time, whether it's to pay off the mortgage or to pay
Hmm.
for college and
Hmm.
and things like that. So and because I've been in the business for so long, I'm going to say there's very few instances where I'm surprised where the insurance is being used necessarily for a specific purpose.
Right.
I think the one that struck me as interesting more recently, having moved to California, is that older folks who can't afford to say go into a nursing home like a CCRC,
Right.
um, they rely on their kids to pay for that sometimes, right? And if their kids are able to, I know some clients who they go into a CCRC, they can't pay for it, the kids pay for it, but then now you're drawing down the kids' assets, and by kids I mean at this point they're in their 50s, right? Mom and dad are in their late 70s, early 80s, so they're placed in this nice facility, but the kids are paying for it, which draws down their assets, and then that leaves less for them for their children. So for
What,
Gen 3, it becomes a
can I
problem.
can I back up here?
Sure.
You said an industry term, CCRC. What does that stand for?
Sorry, a continuous care retirement community.
Okay, so you're thinking like assisted living or even skilled nursing at a very severe level.
Right. Well, it actually it's a graduated process,
Uh-huh.
right? So you go into an assisted. It's not quite assisted living. You're independent living, and
Right.
then ultimately you get to be moved over to assisted living
Right.
and more in depth care.
Sounds like the hardest part of that is is just money. Um,
Yeah.
and so what you're saying is that life insurance can be used to insure the life of the senior,
Yes.
while the children are going to pay for the are going to pay for the life insurance, but they're also going to pay for the facility, which can be anywhere between 6,000 up to even $20,000 a month.
Right.
They can go very high. So the kids' assets are being spent down. Their retirement savings, their savings for their own life is being drawn down, and the life insurance on the death of the senior is being used to replace that money. Is that what you're saying?
Exactly. Exactly.
Okay.
It's almost and the way one client put it is basically I'm loaning my or they're loaning me the money, right, to go into the facility, and then
Mhm.
they're getting paid back at some point.
Yeah. Seems as though insurance, as you get older, insurance gets more expensive. Is
Oh
that
yeah. It's
yeah?
much, much more expensive as we get older.
Why is that?
Well, I mean, because we're closer in that case, we're closer to mortality, right? So someone buying insurance when they're 30, the likelihood of them, dying in the next 10, 20, 30 years is very low
Yeah.
versus, if you're in your 60s, then 70s, then 80s.
Yeah.
Uh,
I think that I explained insurance to a client in this way. Let me make sure that I'm right. So you correct me if I'm wrong. But I think that I explained it to a client by saying that insurance companies really sell one product. They sell a product by taking in premiums, which is payments to the insurance company.
mhm.
The insurance company invests that money in whatever way that the insurance company can. And then the insurance company is betting that based upon the overall structure of all their policies and annuities, that they're going to pay out less to their customers than they took in plus the plus the investments. Is that fair?
Yeah, that is fair because I'm going to say the number is very high, but the percentage is probably 90% of most term insurance. So those, that's the temporary policies.
Mm-hmm.
They don't pay out, right? And
Right.
that's good for all of us. We don't want to die prematurely. It's just in the event of,
Right.
then then your family gets that
Yeah.
money. But from a personal standpoint, I know what this is like because my dad died at 49, right? So it does happen.
Right.
So it's nice to have that policy so that the family can continue living in the home.
Yeah. Yeah, I think in all of my work, I see a lot of clients who have passed away and they have life insurance or disability insurance or accidental death insurance. And I've never seen anyone complain that they were overinsured.
Right. It doesn't happen. But I will tell you that by the time, if they're talking to you, they're doing their estate planning, right? Which is
Mhm.
smart. But there are a lot of folks out there who haven't done any sort of estate planning. So they haven't, spoken to you yet and they don't have the insurance. Um,
There's a weird thing that's happened with several clients where I've been the client never explains this to me, but the family member does. Family member says, "Hey, um, my dad doesn't want to do planning because he doesn't want to think about death because he's afraid that if he thinks about it, then he's going to die."
yeah.
Does that happen to some of your customers?
Yeah, all of them. I'm going to say the vast majority. It's one of those things where it's not even done, I think, on a conscious level, but subconsciously, the minute you start talking about certain things and you're planning for it,
Mhm.
you're preparing yourself emotionally for that, event that we all know is going to happen. We just don't know when.
Yeah. Yeah, there's only two things that you can't avoid in life, and that's death and taxes. It
Yeah,
happens.
absolutely.
It'll happen. Yeah. Yeah. So you came here from Chicago in 2019 and you came here because you have how many kids? How many kids went to college?
Just one. I have one daughter.
One daughter. And what does she do now for a living?
So she just graduated actually just
Ooh,
a couple weeks ago. So she's a psychology major. She's going to be working
congratulations.
initially. Yeah, thank you. And then she wants to go on to grad school.
Okay, what is she doing for grad school? I don't want you to like out her or anything, but
No, no, no. So what is she gonna she wants to be a psychologist. And what is she gonna do specifically? She doesn't really know, right?
yeah,
She's a kid. From my perspective, she's still a kid. She's got,
sure.
time to sort of figure it out.
But you have a family and
Yes.
you're here in California because of your family. That you're
Right.
actually that you said Momo, is that what you said?
Oh, me, the what they call me? No, Como.
Como, sorry.
Yeah, it's okay.
Como. That's funny. I'm gonna call you that next time I see you. I think I'll see you next week. Yeah.
Yeah.
Yeah. Well, tell me some things that people wouldn't know about the insurance process that they should know about before they started.
Well, so one of the things, so in my business, it was very typical for because I work with a lot of higher net worth clients who do the estate planning for estate tax purposes. They tended to be older, so that's the clientele I was working with in Chicago. Here, the wealth is much younger, so you can meet a founder who's 30 something years old. One minute, he's worth nothing, and the next minute he's worth over $100 million, right? So
Mhm.
that happens out here. And so one of the things I tell them is it's better to get insured early because one of the things that not just I'm noticing, but everyone is noticing is that health issues are cropping up for all of us at an earlier age. So
Yep.
my the 30-year-old client who has all this money, he also has a lot of stress. He's got high blood pressure, he's got elevated sugars, he's got a lot of issues in his 30s that we didn't see before. And we're seeing them now.
Yeah. That's interesting. You are correct that in Chicago or other places that the wealth is much older because it takes a lot longer. But here, there's so much more leverage just because of the capital that's coming in, plus all the code generated, right? So the
Right.
capital and code just multiply. They multiply someone's efforts an infinite amount. I have lots of clients who have a taxable estate. So let's define what that is for our audience. Okay. So a taxable estate, everybody can give away a certain amount of money during life and at death. It's called a gift and estate tax exemption. It's a joint exemption. And right now, the amount that's exempt is $13.61 million. At the time of this recording, it's 2024. In 2026, that amount that each person can give away, $13.6 million before paying taxes, is expected to reduce to about $7 million, somewhere around there. And everywhere above, everything above that number, above 13.61 now and maybe 7 in 2026, that everything above that is taxed at 40%. So I think what Natalie is saying is that she's saying that some of her customers have more than $14 million for a couple, $7 million for the one spouse, $7 million for the other, combined 14, and they have more than that amount of money. And so they want to reduce that 40% tax to other people that their children or grandchildren or whoever would have to pay. And so they get insurance to essentially pay the tax so that they don't have to sell things. Is that fair?
Right. That's a great explanation. And I think what's interesting too is moving out here from Chicago, everyone here has a lot of their wealth tied up in real estate. So they own a lot of rental properties, what have you. And, they're illiquid versus, in New York and Chicago. So that's the other reason why, I'm a big proponent of looking at the insurance policy in an ILIT,
Right.
irrevocable life insurance trust.
I have lots of clients who have lots of real estate or businesses, and they would have their kids would have to liquidate. Their kids
Right.
are going to have to sell unless they're able to get a really good insurance policy. I'm insured. I'm insured. I think I have a 20-year term policy. And why is it term? It's because we need to ensure the fact that while my kids are younger, that we need insurance. And after my kids are gone and off to college, we assume,
Right.
hopefully the kids will be self-sufficient at some point in the future. And so we won't need to insure my wife and I because we'll have other savings. So the insurance is really there to make sure that everything's okay for the kids while they're young. And then when they're older, then we don't need the insurance anymore.
Right. Right.
Yeah. Well, what if someone were to come to you? What's kind of the first question that you ask them?
Typically, I'll ask them what their objective is for the insurance, right? So a lot of times people won't know exactly what the objective is. They're told, oh, this is a good idea. I need to have this. And so I will ask them, is this to replace your, the mortgage and the college? Is it, what specifically is this for? That's primarily what drives the process.
Yep.
Because that's going to dictate what kind of insurance that we're looking at. So in the case that you get, the example you gave of yourself, term insurance, that's perfectly appropriate for you because you're covering it for this period of time. And then at that point, your kids will be older and, like you said, hopefully self-sufficient. But then, for other clients who do have a taxable estate, they'll, I'll say, well, then we'll need to look at permanent insurance and here are the different options for permanent insurance. But then the next question is then going to be, what is your health? Because that's really the driver here. Second to your age, it's going to be your health.
Okay, so it's age and health are the two determining factors when you're talking about insurance on your body, which is what you do: disability, accident, and life. Right. Let's talk for just a minute because I don't want to go too far into this because it gets kind of complicated. But how does that estate tax life insurance actually work?
So typically, if it's a husband and wife, I will recommend a second to die policy because it drives down the cost a lot. And the reason is because the insurance company is not paying out the death benefit until the second death, which is typically when state taxes due, is on the second death. So we'll put that into a trust, into an irrevocable life insurance trust. And then upon the second death, it pays out to the trust, and then the trust uses that money to pay the tax.
Okay. So let's define some terms. Okay. So you said second to die policy. What does that mean?
So it means that it's a survivorship policy or second to die policy. So husband and wife are covered, and the insurance company will pay. And typically, the husband passes first. I hate to tell you that, Elijah, but I think
It
right?
does. Yeah, I know.
Yeah. So husband passes first, and then the wife, after she passes, then the trust receives the proceeds from the insurance company.
Just so you know, there's a rule in my house that I can't die first.
Oh, okay.
So I intend to follow that rule, but my wife will probably tell you, Elijah, you're not allowed to die first. And I'm going to do my absolute best not to. Okay. But who knows? Right. Okay. So that's number one. Number one is second to die policy. So you can actually have a policy on one person's life or two people's lives is what you're saying.
Right. And it's much, much more cost efficient if you insure it on two people for that reason.
When you say cost efficient, that just means cheaper.
Yes.
Yeah. Okay.
That's why it's
Because
cheap.
it's less likely that that both people will die at the same time, and so the insurance company then has more time to invest the premiums and get more money before they pay out.
Exactly.
Okay.
Exactly.
So second question then is a life insurance trust. So describe how that works, and then I'll fill in the blanks.
So a life insurance. So typically, if I'm sitting down with a client and I find out, okay, this is specifically for estate tax purposes, I will tell them, we need to put together an irrevocable life insurance trust. You need to get an attorney involved because if you own it, and this is the other thing about insurance, people don't realize you could receive the proceeds from insurance. The beneficiaries do tax free, but it's still included as part of the estate. So,
Mm,
for example, I have a client who, between his business and various real estate holdings, right now by himself, his estate is over 25 million. And he
mhm.
said, "Oh, I'm just going to own the policy." He wanted to buy a $7 million policy, and I said, "Well, now your estate is going to be 27 million. Are you? I mean, we. This is why you need to put this into a trust, right?"
Yeah.
So that's typically what happens.
So if I can understand correctly, what you're saying is that when someone dies, there's a certain amount that they can pass without paying estate tax. It's called the estate tax exemption.
Yeah,
Currently, if we go back to the number, 13.61 today, 7 million in 2026.
right.
If they have life insurance in their personal name, meaning I buy life insurance on Elijah's life and Elijah dies, the value of that insurance, even though it pays out to someone else, is included and I am taxed on that. Is that what you're saying?
Exactly. Because you own the policy. Right.
Because I own the policy. And so what happens then is then the person that creates the policy needs to make a gift of the policy but control it. So that's what a life insurance trust does. It's
Right.
a trust where Elijah buys a policy on Elijah's life, but Elijah, I give the policy away so that during my lifetime it's held in a special trust, but I don't own that policy anymore. The trust owns that policy. It doesn't work with a revocable living trust, right? I mean,
Right.
it's not like Elijah's revocable trust. It doesn't work. It has to be a very specialized tax trust.
Right.
It's a
It
tax
does.
instrument. Yeah, the
Right.
devil with the in tax trusts, the devil's always in the details. A lot of tax trusts look very similar, and so people say, "Well, this is stupid. This looks exactly like any other trust," and the answer is no, it does not.
I can't tell you the number of people I've talked to who've said, "Oh, I don't need to talk to another attorney. I already have a revocable trust, and
Yeah.
so we're just going to have that own it." And it's like, no, that's not accurate. So it has to
No,
be a revocable trust.
why it sounds to me like you're saying that there are different types of estate planning attorneys that specialize in different things.
I think that well, I do have a funny story. So I did meet with a gentleman when I first moved out here in 2019, and we were
Mhm.
talking about, tax and et cetera. And I said, a lot of the insurance I do is for estate tax purposes. And he said, well, I don't have that issue, right? And then I come to find out he owns 7 properties in Half Moon Bay. And I said, oh, it, I don't know. Regardless of when you purchase them, you have a taxable estate. He
You
said, no,
do,
no,
yeah.
each house is in a revocable trust. And
Uh-huh.
I said,
Yeah.
so let me see if I understand this. Your attorney put each of those properties into a separate trust and never told you like what the implications were. And he said, no, no, I have 7 different attorneys who drafted those. I said, why would you do that? Right? Who does that? And he said, because I would ask, because, he said, these things cost money. And I said, you know what costs more money? Mistakes.
Yep.
Huge mistakes cost way more money. Right.
Yep.
But I always share that story because I was like, I was shocked. I was shocked.
Yeah.
So,
I'm laughing because you need one revocable trust, not seven. And if you have seven, it causes confusion. So what Natalie is saying is she's saying if you have 7 different trusts, you have 7 different trustees who are going to argue about 7 different pieces of property. And now the kids have to go through 7 different individuals to get 7 different houses. That
yeah,
seems ridiculous to me. Just make one.
Yeah, and it is entirely ridiculous. But not only that, but that means that each attorney didn't ask all of the questions, right? In order to find out exactly what your assets are, how are they held. So he basically went looking, forum shopping, right? He went forum shopping to basically see who's going to offer him the cheapest trust. And like you said, he didn't even need 7 trusts, but he thought, this is
He
how I,
needed,
yeah,
yeah, he needed one. Yeah, and an estate plan is supposed to be all inclusive. I don't like loose ends.
right,
Personally, I don't I like things wrapped up in a nice little bow. I don't like having multiple trusts if we don't need them. I create plans with multiple trusts all the time, but each trust has a specific purpose. So just like what you said, each type of insurance has a purpose, each type of trust has a purpose. Natalie, I really appreciate you coming on. How do people find you? How do people find out about you?
So they can email me at Natalie, Natalie, at Taran Insurance. That's T as in Tom, A as in Apple, R as in Rabbit, A as in Apple, N as in Natalie, insurance.com. My phone number is still 312. It's 312-953-4948.
Yeah. And if people are going to walk away from the episode today, if they're going to remember one thing, just one, what would you want them to remember?
Well, what I would hope that they remember is, it doesn't cost anything to talk to a professional like myself, just to work through and know it's better to be informed than uninformed, right? Because it has implications for our families. So it's better to know and get, the advice and just recommendations. And if you decide not to do it anyway, at least you're making that decision, an informed decision, right? As opposed to no idea and just doing or not doing anything.
Very good. Well, thank you so much. Do you have any questions for me, or are we good to go?
No, this is great. Thank you so much for the opportunity. I appreciate
You're
it.
very welcome. And just so everybody knows, Natalie is my insurance broker for disability. So she's getting insurance for me currently. And then in the future, I need different insurance because I own a business. So any business owners out there, you can actually work with Natalie or another broker for key person or buyout insurance. So for my business, I have key person insurance, and then my personal life, I have personal life insurance. So I have like 4 life and disability policies. Each one serves a different purpose. So it's all about the purpose. Insurance is a tool, trusts are tools. Natalie's an expert at what she does. She's very good. From my estimation, she's very good.
Thank you, Elijah.
You're very welcome. This podcast is The Keys to Your Legacy. You can contact us in the show notes below. But if you'd like to contact my firm, we do estate planning instruments as well as irrevocable life insurance trusts. I work for Keys Law Group. I'm the managing partner there. Thank you for following along. Please subscribe to the podcast so that you never miss an episode, and make sure that you watch future episodes so that we can help you create keys to your legacy. Thanks so much.
You've been tuning into The Keys to Your Legacy with your host, Elijah Keys. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, keyslawgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.